Good afternoon, everyone, and welcome to the second installment of Deconstructing Effective Trading with Brian Schad. My name is Brandon Fargo, and I'm with Farnsfield Research. We're a market research company that discovered Brian about 5 years ago. For those of you who missed Brian's debut webinar with us in March, Brian Schad is a longtime protege of the famous futures trader Larry Williams. Brian has successfully traded commodity futures spanning over 3 decades and is now with us today to discuss some of the technical aspects of his proprietary winning strategy. Brian, welcome.
Hi, Brian. Brandon, rather. Thanks for inviting me back and having me today.
Yeah, it's our pleasure. Just so the audience knows, we're going to have a section of the webinar where we will be taking questions from the audience. Obviously, we'll not be able to get to everyone's questions, but a member of Brian's team will follow up with everyone that attended to make sure all of your questions are answered. I know people are very excited to get into the specifics of your trading, and we have a huge turnout, so let's get into it, shall we?
Yes, by all means.
All right, Brian, if you want to start talking about what indicators you specifically use to follow, as you put it, the big money.
Well, Brandon, the big money indicators I use always start with the Commercials Traders Index. These are the real movers and shakers of the market, in my opinion, because they are the actual users and producers of the physical products, such as corn, cotton, livestock, and so on. I think I have an example here of cotton, or copper, rather. They know their market better than anyone else. I use several other common indicators that Larry taught me about 10, 11, 12 years ago that I'm going to share with you as well. Can you see my copper chart on
yeah,
computer?
Looks like it's pulled up there, yeah.
Okay. So the indicators that I use to follow the big money are very standard indicators that most folks know, such as the ADX, such as the stochastics. We have a seasonal tendency indicator here. And then the main three are the Commercials Index and the Large Traders Index, and we also have a Market Sentiment Index. There's another proprietary indicator that isn't mine to talk about that I also use on here, but these are it.
Okay. Yeah, we can't give it all away. In that case, how does the big money move the market, as you put it again, Brian?
Well, in my view, again, big money doesn't necessarily move the markets, but rather keeps the trend going in one direction or the other by their inside market convictions, I would say. It's buying or selling pressure is what actually moves the markets on a day-to-day basis, which is why we see big pullbacks or sudden retracements against the trends of the markets we trade. So to recap, big money sets the trends, and buying and or selling pressure provides the ups and downs of the day-to-day business of trading.
Okay. Why do you think this is important to you?
Well, this is especially important to me because I'm a trader of commodity markets, not an investor. I think we covered this aspect last month, but I really do try my best to exploit the up and down zigzags of the market rather than the buy and hold approach as an investor would. Since I follow the commercial traders on a weekly basis, which I post each Friday to my site, I know when the beginning of the new trends begin, and I only want to be taking trades in the direction of the new trend.
Okay. Maybe in that case, could you show us that on a chart there, Brian?
Oh, okay.
Going back to the beginning of the trend to present day.
Sure. This is the copper market that I have up here, and right now the trend is clearly down in copper, but we see almost an extreme showing here where the low of last week, if we work our way down, the commercial index are buying futures, hedging against the positions that they're selling the actual physical product. We don't have market sentiment or large traders down here in the opposite extreme of the commercials as I would prefer to see. But other indicators such as the seasonal trend and the stochastics are also giving a warning. The way it was taught to me by Larry is, we want to see a minimum of 3 or 4 of these longer-term 7 indicators in the direction, informing us of an impending change in direction. But the last time we had an extreme like this, Brandon, was going back a few months. This is going back to the beginning, the first week of February. We come down here and we see that the commercial traders were net short. The large traders were just the opposite. The stochastics were in the overbought territory. And so there's at least 3 or 4 indicators right there. And sure enough, the indicators did forewarn us of a change in trend from up to currently down. So this is really powerful stuff that cannot be overlooked.
Oh, it's pretty interesting. How long will you see these trends usually last?
Brandon, these trends can last for months, but I know there will be events and news around these trending markets that will cause pullbacks in uptrending markets and temporary spikes in downtrending markets too. It's important to understand markets just don't travel in one direction the entire time of the trend, and it is our opportunity to await these conditions and zigzags to re-enter with positions, buying the dips and selling the rallies as best we can.
Good stuff. Good stuff. So Brian, when big corporations invest in futures to protect themselves, how does their protective trading affect your trading decisions?
Okay, the 14 agricultural markets I trade are the very markets which make the world go around. Grains, livestock, cotton, sugar, coffee, and even precious metals are included. They come out of the ground too, right? Well, the corporations and companies that use these products, such as Kellogg's, General Mills, and Pillsbury, are at risk during the growing season for all of the crop markets, and even industrial companies are at risk with supply and demand of copper, silver, and even gold. If an overseas government is preparing to import millions of tons of corn, for example, in the month of August, and the price of corn is currently very cheap or inexpensive, and isn't expected to be this low in price very much longer, then they may elect to buy corn futures now to lock in those low prices. On the other side, wheat farmers are generally frustrated this time of year because wheat prices generally fall in the summer months. So when there is a spike in wheat prices this time of the year, and wheat farmers have an opportunity to lock in generally higher prices now because they don't expect prices to be this high when it comes time for them to sell, then they will sell wheat futures to protect themselves from falling wheat prices. This concept goes for car companies and home builders regarding the price of copper, livestock ranchers with the price of corn and wheat used for feed, poultry producers of soy meal, and on and on. It behooves me as a trader to know these temporary market conditions are what cause the pullbacks and spikes in the market, and more importantly, to anticipate them in trading with the trend. I hope that answers your question.
No, more than I expected, to be honest with you. Let me ask you this, Brian. What indicators help you identify these trends in the market?
Well, first I use my weekly chart indicators, which we just gone over, to indicate a probable change. And I said a probable change in trend, as I just explained. Mm-hmm. Then I use both the 18-day and 10-week moving averages to either confirm a trend change or verify the trend has changed. Let me make a daily chart out of this weekly copper chart if I can. Let's see, daily. And let me go to, okay. All right, so here are the indicators that I use to catch the trends. I talked about the 18-day moving average. This is this red line here. You know what, let me see if I can make this, there we go. The 18-day moving average is this yellow line right here. And I'm sorry to be switching back and forth on you. I'll just keep it here. This lighter red line, or pink line rather, is the 10-week moving average. Other indicators I use here are the very indicators that my teacher taught to me all those years ago. This is one here that Larry also popularized back in the early 2000s. He called it ProGo, and this is a two-line indicator which illustrates which side of the market I should be concentrating my efforts on. When the green line of the professionals is below the red line of the public, then I should be concentrating my efforts on the short side of the market. Conversely, when the green line is above the red line, I should be concentrating my efforts on the long side of the market. Not a timing tool, but one that just helps me keep on the right side of the market. And then I've got a couple other indicators such as the percent R and RSI. And I even look at seasonal trend and seasonal percentage of up and down days. But these are really it. These are the markets that I use. And like I said, not a timing tool, but rather a tool to confirm what side of the market we should be concentrating our efforts, either long or short. And you know, that there's one indicator that I don't have on here, and we can't forget that one, that's experience. But other than these very basic tools, Brandon, I do indeed rely heavily on price structure, momentum, and patterns in the market.
Great, great. Now that you actually mentioned the percent R, and also in our last webinar, a number of people asked if you had a percent R indicator at the bottom of your charts. You know, tell us, Brian, what does the percent R indicator do, and how does it apply to your trading?
Sure. The percent R indicator is an original Larry Williams creation of over 40 years ago. If you study Larry Williams' work and material, you'll know this tracks today's closing price to that of previous closing prices in the past. It's a very basic forewarning indicator as opposed to an actual timing and or pulling the trigger tool. That's just the way I use it. I mentioned to you right here, I have RSI combined with the percent R, and it's just when the percent R is above this line here, we are in the possible sell zone. So we should be looking to sell copper here very soon. A couple of weeks ago was another forewarning of a sell signal in copper, as was early in April. And it's when these percent R values get above the sell zone in a downtrending market, that's where I want to concentrate my efforts. It's just the opposite, you know, for an uptrending market. When the percent R is in the buy zone, I want to be sure to act upon these signals thereafter. Brandon, that's all I use it for, simply a forewarning tool.
Okay, great. Now, what about chart patterns that you look for to identify trends and entries?
Okay, not so much in identifying trends, but entries, yes, by all means. There are as many chart patterns out there as there are traders to interpret them. I don't want to portray myself as a trader that knows all or sees all chart patterns. No. I only look for the specific chart patterns that I'm familiar with and are important to me and my unique method of trading my personal strategies. Too much to get into here on this forum, a forum like this, but to go any farther than that, we'd never go home or see our families again. Believe me. We can talk all day about it.
And in that case, what do you look for to exit a trade? A lot of people know how to get in, Brian, but I think getting out is probably the hardest part.
Certainly. First, let me say I always prefer to let my profits run and cut my losses short. I know that's a cliche, but this is precisely how you rack up the equity profits. In my style and methodology of trading, I simply go for the base hits. And every now and then, I hit a home run without even trying. I just happen to catch the move, like gold at the end of last month. But you asked me what I look for to get out of a trade, so sorry if I'm being a little discursive here. All right. I will never enter into a trade without first knowing at which point I will exit the trade. Sometimes I am in and out in the same day, which is just the way it goes. But when I am in, I am looking to catch a move with the trend and will adjust my protective stops each day based on price structure, patterns, and or volatility until I am ultimately stopped out of the market.
That must take a high degree of self-control. Can you elaborate on how your indicators and discipline take the emotion out of trading altogether?
Okay, well, my indicators are only there to guide me in my decision making, and my trading strategies are all back tested and quantified as far back into the late 60s in some of these markets. So I have probability, I have statistics, and I've got the odds on my side at all times. Now, this doesn't mean I am right about this specific trade I am in, but once in, I must indeed let the market play out with as little involvement as possible.
Okay. So then once in a trade, how are your stops implemented, and how do you calculate your threshold per position?
Sure. I mentioned just a few moments ago, never place in a trade without first having a predetermined protective stop. Well, as long as I am still in the position, I am trailing my exit stop based on price structure and volatility. Is the market continuing to make higher highs and higher lows when I am long, for example? I'm looking for price patterns like the relationship of the market settlement price versus its opening price, and the opening the next day to the close of the previous day. And if the market is in the midst of wide swings or making limit moves, I'm certainly looking for a way out if that's the case.
And what about profit targets?
Profit targets. Something I prefer to avoid because it conflicts with my basic philosophy of letting the profits run, cutting the losses short, or specifically going for the base hits and sometimes realizing the home runs. Profit targets in futures trading conflict with this basic tenet. There is a place in options trading for this view to be profitable, but that's another webinar, Brandon. However, sometimes I do have to incorporate profit targets, but when I do, I take my cue from the market not being able to hold its gains, or I may be in a position that I might feel is running its seasonal course. A couple of weeks ago, Friday before last, I had been long hogs from earlier in the week. Let me see if I can bring up that hog chart. Hogs, where are you? All right, can you see that, Brandon?
Yeah, I can actually.
Okay.
There we go.
All right, I noticed two things on my chart. The market was approaching a 4-week high. You know what, let me switch over to my other view of the daily chart. Okay. And the seasonal tendency was already in sharp decline with emphasis on the 2 days of the month. I knew there was a very strong resistance up at these levels, and if the market broke through, it may take out a whole lot of buy stops and then most likely retreat. So here it was. I actually have the buy signal on here. I had been looking for a buy signal in here, and I got it right about here on this day. This was a Wednesday, and we had been long through Friday, but I saw the market approaching this 4-week high over here. So I knew that if the market took it out, it would most likely take out some buy stops up here at these levels and retreat. I ended up getting out that day, and the market did retreat. Looks like I would have been stopped out anyway, right about where I got out. But I exited the hog market just 3 market ticks from the high of the day, and didn't stick around to find out what's next for this market those last 2 days of April. So again, the hogs were shaping up for a pullback in price, and the seasonal tendency kind of tells me that over here, especially the last 2 days, if you can see those 2 strong down days. Mm-hmm. And then eventually I'm looking for them to rise. But just like the seasonal tendency shows, we're coming down into today, and because the trend is up, the percent R is in the buy zone, the Pro-Go is still on the buy side. I'm looking to take advantage of this seasonal tendency for hogs to rally this time in this month of May. So profit targets do sometimes apply, but it is advised not to get into the habit of profit targets each trade that we're in. Hope you're going to understand that.
Yeah, no, definitely. Let me ask you this, Brian. How do you know when to hedge your position or when it's needed to utilize options?
Okay, do you mean use options instead of futures contracts, or utilize options around futures positions? Because I actually wrote the book on the latter, literally. I'll comment on both. Okay. First, I know when to hedge my position when I get certain exit signals, which I feel are premature in a trending, volatile market. Instead of exiting the position altogether, if the conditions are right, selling a covered call or selling a call or calls and buying a put to hedge, my long position will at least keep me in the market and in a position to capitalize on an extended market move higher. The second part of your question inquired when it was needed to utilize options, as in just trade options. Mm-hmm. So, Brandon, when a trader utilizes options, there are much more variables involved to be consistently successful, rather than studying if the market will just go up or down, which is my expertise. A savvy options trader also trades volatility and implied volatility, which is beyond the scope of this webinar, actually. But before moving on to the next question, let me say option trading can be a great way for novice traders to begin real-time trading because of the unlimited profit potential, limited risk profile. But later, beginning traders, ones just using options contracts, soon realize option premiums and underlying futures moves correlate differently than expected or even desired. But my first real-time trade in the markets was with a sugar option contract. Made $380. I think that was a good omen.
Definitely, and here we are. So we touched base on stops and your what's your threshold per position?
Sure. Let me bring up a current corn trade. Let me find corn here, and we're talking about threshold per position. Okay. I have been defying corn lately. The trend in corn is down, and we're talking about threshold per positions. Okay, so this may not be the best example because I'm going against the trend only in this case. But I mentioned earlier, when my trades are initiated, that is the only time when I generally know where the stop will be implemented, because thereafter the stops change each and every day based on price structure, patterns, and volatility. Very rarely do I implement a threshold stop on a position, but I'm going to show you one here on corn, because I want to give the trade room to materialize. But some traders do fall under some trades rather fall under a now or never, do or die approach. And then I place a threshold based on price structure, pattern, and volatility. So for corn here, I had been long corn from this day right in here. and I happened to catch that limit move up. It was just a lucky. I just happened to catch it. It was limit up. I thought for sure the market was going to cover this gap in here. We came close to it, but you know, I'm measuring the volatility of the market, and I'm also looking at price structure. So at this one trade here, it's a counter trade trend. I also implemented a profit target, which was right here at the top of this gap. It didn't materialize, but because I was trading against the trend and I had a profit target, I wanted to make sure that I was utilizing the price structure of the market and the volatility. So even though we didn't hit our price target, we happened to get out based on this limit move up. You can see the market closed on the high of the day. When the market closes on the high of the day, in this case it was limit up, but in all other cases it kind of tells me that in a downtrend and the market closing this strong up, the last real buyers may have already bought. And this is another forewarning sign. So I didn't want to press the target. I wanted to make sure that if the market went against me, that I was out. I ended up going long again a couple days later, and just this morning the market opened up down a whole lot and just continued down. I think I lost about 6 cents here, but the market it appears to be either changing trend or you know, we may be seeing a midst of a change in trend, which it may imply also a sideways trading market for some time. But this is how I utilize price structure, patterns, and volatility in the markets that I trade.
I'm glad you mentioned the volatility. That was actually my next question. So how do you measure market volatility on a daily basis?
Okay, either an average of the past trading week, or if the market has been making higher highs and or higher lows, I might take it day by day. If the market is making an exceptional high or low, I might measure the intraday volatility. No rocket science here. I really do allow for the market to tell me what to do because I want to work with the market, not necessarily beat it up each time I'm a participant, if you know what I mean.
Okay. Do you trade the most active contract month or forward months to hold longer, and why?
Very good question. I always gravitate toward the most active contract month, the one with the largest amount of open interest, not necessarily volume. But in the case of a market such as wheat, when this time of year, when the trend is usually down, sometimes I will enter into the forward, the next forward month to get in while the open interest is gaining on the front month, only in an effort to be in the forward contract month before those that are long, the active contract, are forced to exit their positions because of first notice day. I try to exploit first notice day as much as possible. First notice day is the date when all long positions and all long participants must be terminated or accept delivery of the product. Because of this procedure and those speculators holding long positions must be out, sometimes it's like musical chairs to see who will get out first before prices are skewed against them.
Okay, well that's all pretty interesting, Brian. Thank you for that. We're going to be taking questions from the audience now. Remember, if we are pressed for time, someone from Brian's team will follow up with everybody from the audience to make sure your questions are answered. You can also send those to info@farnsfieldresearch.com. First question from the audience: what moving averages do you use and why?
Okay, we actually talked about this a little bit earlier, but I'll go over it again. Okay. I use an 18-day and a 10-week moving average on my personal charts. No hocus pocus, magical reason other than they are the most common moving averages used. All right, so I got a daily chart, but let me switch over to my other view of the daily charts. Again, this darker red is the 18-day moving average, and this lighter red or pink-colored moving average is my 10-week moving average. The 18-day is a shorter time span, which alerts me to a most likely trend change, while the longer 10-week moving average verifies a market may be in a bona fide longer-term trend. The longer-term trend, it helps me stay on the right side of the market. So let me see if I can make this right. What did I do wrong? Zoom out. Okay, here we go. So again, the 18-day moving average is a shorter time span. It helps me identify a possible change in trend early as possible. And the 10-week moving average, once the market closes with 2 higher consecutive highs above it, it kind of confirms to me that once the trend has changed for me in my work with the 18-day moving average, that it's confirmed a bona fide trend change, and hopefully my other indicators are also prompting me to be on the long side of the market as well. So so the 18-day moving average is one I find the market tends to gravitate to when trending in either direction, and a good place to consider entering back into when not in a position.
Awesome, awesome. Wow, Brian, we have a ton of questions coming in, so we'll try to get to everybody. Second question is, what is the average and standard deviation for slippage in your trades over the last 3 years?
You know, I was just asked this very same question about a month or so ago. I understand the context of the question as a concern about slippage in our trades. This was a major issue for me during the days of pit session trading, but the last pit session traded market for me was Kansas City wheat. All of the markets and strategies I trade are entered into on the electronic platforms exclusively. Since my trading strategies only trade the electronic markets with either stops and stops with stop limits or sole limit orders, I have virtually eliminated gross slippage on at least the first half of the trades I make. The slippage these days, Brandon, on the electric platform is absolutely minimal compared to the pit session fills I had to accept not so many years ago. The prices I record each day, by the way, are the actual fills from the markets that I get from the brokers I work with each day.
Okay, great. Looks like we still have some time. So, Brian, if you could talk a bit about the profit factor of your system and how the commodity margins play a role in that.
Okay, this is probably the most important aspect of my trading as it confronts the practice of money management. The profit factor is the amount of money of all the winning trades divided by the dollar amount of all the losing trades. The profit factor will inform me if the trading strategy is worthy enough to pursue, because the higher the profit factor, the better probability for future success. No guarantees, and never any guarantees in this business, but most of my answers to trading are found in the profit factor. And you know what, let me bring up the profit factor here. We're looking at corn, and let me see if I can bring up profit factor here. Okay, I'm going to look for profit factor. So this will bring up the profit factor that I use, and let me expand this measure. Okay, so this is all the trades. Actually, I believe it's all the trades for the corn market, and it goes back to 1968. And all the trades that I I use for the corn market are programmed in. It's mainly the entry and exit. And the profit factor of 1.62 tells me that for every losing trade that I have, the winning trades make up for those 162% of the time. Okay? Mm-hmm. And I want to focus on the higher profit factor as possible. Now, I mentioned to you this goes back to 1968. Let me show you what it has been in the last 12 years that I've documented these trades, going back to January of 2001.
I think you may have to minimize it a little bit so we can get the left side in.
Oh, okay.
There we go.
All right. So again, here's the profit factor. This doesn't go back to 1968 like the previous example. Mm-hmm. This is just the last 12 plus years, going back to January 2001. People say, "Oh, Brian, maybe your trading methods might be outdated, or they don't work so good anymore." I say that's baloney, because look, I just showed you the past 40 years mm-hmm. Or so, and now in just the past 12 years, the profit factor is 153, or the profits are 153% better than the losses. Wow. And that's still generally a good value. Mm-hmm. So after many years of trading my strategies, I accidentally uncovered a simplistic money management strategy for the various models of my trading and my nightly ag report. What I uncovered has been needed all along. It's about markets taking priority over other markets based on account margins versus the profit factor of each market I trade. Brandon, I discovered all markets that I trade have formidable profit factors, otherwise I wouldn't be trading them, but the higher profit factored markets with the lower margin rates should be considered being traded first. So I prioritized all of my 13 or 14 markets I trade, 1 through 13. In other words, instead of me taking trades and reading my and others reading my nightly ag report and guessing which markets they should trade, the profit factor and margin rates have figuratively done this for them. Mm-hmm. So the profit factor has been the second best discovery in my trading, aside from finding an actual strategy to trade that works all those many years ago.
Okay. We've got some more questions here. Do you trade spreads in futures, or?
Okay. I am looking more and more into spread trading, and they can be very, very profitable with very low margin, but I have not delved into that aspect of trading. Maybe more than I should. I should take a more look at that, but no, what I'm doing now keeps me pretty busy.
Yeah, I bet. I bet. And we had another question. Asked if you were a day trader, day trading commodities, but maybe you can elaborate on why you trade
sure.
A swing style as opposed to day.
Okay. Well, I've been trading this way for many since the beginning. I've always looked at trends, studied trends, and have taken trend trades. But I used to day trade S&P, the Russell 2000, and the NASDAQ. But I found that even though I had profitable year to year in day trading, there were certain portions of the year that I just went into a drawdown that, for those day trading with me that just started recently and I went into a drawdown, it was not a nice, inviting, hospitable way of, having new traders trade with me. So I actually stopped day trading back in October of 2008 or 2009, and now I just focus on these 13 or 14 agricultural markets. These are the best markets of the physical commodities that I trade. I just concentrate on them, and I have no desire to get back into day trading ever again. I've been away from it this is my 5th year now, so I don't think I'll be returning.
Yeah, it's been more of a racetrack, I would imagine. Huh?
That's what it is.
Yeah.
You've got to be there. The brokers that we utilize for day trading, they're also servicing other customers that aren't day trading, but even the other day traders that they're servicing, if they put you on hold for just 15 or 20 seconds, there goes your trade.
Right.
And if you do it electronically and you fumble, with big thumbs and index fingers like me, you're going to learn that you're going to make the mistakes, and it defies the objective of day trading. So no, I'm glad that I'm not involved. These ag markets, when they trend, and they can trend for a good number of months, it's really a very low stress form of trading for me, and this is what I want to gravitate to.
Definitely. Well, we've been watching you for years. We know that that's what you're good at. Maybe Brian, let's see, let's take some more questions. Maybe quickly you could wrap up, your strategy, just a basic wrap up of it, kind of like a summary.
Okay, sure thing. Let me bring up another market such as cotton. Okay, here's a good example. Here is the cotton market, and as you can see, going back to January of this year, the trend had been up. So I'm looking to take all trades with the trend. When we look at in another view, all trades with the trend. Okay, here, I'm sorry. Let me get rid of this. I need to bring up cotton. This will just take a second. Please bear with me. Okay, so I'm bringing up my cotton, and here it is. Okay, so all the blue solid arrows indicate where I went long cotton, and all of the hollow red arrows show where I would be getting out of cotton. And so while the trend is up, I'm looking to take all trades with the trend, as long as the market is trending. But as soon as the market, and see, even though the market made new highs here and had a nice sell-off here, the trend was still up. But after so many days and a clearer picture unfolds, eventually the trend turns sideways and or down. And in my work, the trend was down over in here somewhere. Okay. And so I'm looking to just take trades on the opposite side, the short signals, and take all of them. That's really about it. The market is trending up, and the market trends down, and all I'm doing is looking to trade my markets, and all the markets that I trade. This one is cotton. This cotton market has a profit factor of 1.86, which again means that for every losing trade, the winning trades compensate 186% of the time. And this goes back to 1973. So let's go back to the last 12 years that I've documented, once again, since January of 2001. And look at this.
Wow.
In this last 12 years, the profit factor is 223%. So for those naysayers, that it's not working anymore, it's actually working better these last few years. Anyhow, this is what I do. I just follow the trend, and I've got to take the good trades with the bad, but I've got all of the probability statistics on my side. So this is what I try to focus on in my personal trading, and then if I can benefit others as well, I'm fine with that too. But this is my trading in very much a nutshell, Brandon.
It's been very informative. Just so everybody knows, again, if we don't get to your questions, please email them to info@farnsfieldresearch.com. schad.com, and someone from Brian's team will certainly follow up with you and make sure everybody gets their questions answered. Another question from the audience, Brian, and we have a few more minutes here, was in regards to holding overnight. Let me see where it was.
Okay.
When you carry a futures position overnight, how do you protect yourself from a catastrophic move?
This is a great question, and one that I really had to be concerned with when I was primarily trading only the day session, pit session markets.
Mm-hmm.
But now, Brandon, the markets that I trade are virtually almost trading around the clock. So holding overnight is not necessarily, when the grain markets close at 1:15 Central Time in Chicago and then reopen the next morning at 9:30 Central Time. That was a big concern. And I guess that would be only a concern now on the weekends, because if I have positions that I'm holding overnight like I did with corn, and I'm going to bring up corn again because this is the first time I've seen something like this in corn in quite a long time. Let me bring up corn, and right here. Okay, this move here is an overnight move where it gapped from a Thursday night to a Friday. I happen to not be in this position. Had I been in this position, you can see I'd been stopped out way up here from a long trade, just stopped out right there. Mm-hmm. So I'm only concentrating on the long positions because the trend is up. Well, the market sold off heavily, and it looked as if though the change in trend from up to down occurred. It was verified like right here. So I'm only interested with the short trades. So you can see the relationship from the close to the open in most of these are almost close and spot on with one another, and that's only because there's only a couple hours difference. So holding overnight for me is just holding a couple hours, unless the weekend. Now, I had been long corn, defying the trend. I happened to catch this move upward, but was stopped out the very next open, and then I went long again up here, and I held over the weekend. You can see this day here, this small range day here is Friday, and for the first time in quite a long time, the market gapped open below me, but I was waiting for the open since Friday afternoon or the weekend, because I knew once the market opened that I was either going to get out if the market opened higher up here, or if it went 6 cents below the Globex open. So this gap here that we see, this is the first time in quite a while. There also happens to be a second one here because of the fundamental situation changing, but by and large, for the most part, we don't see those gap openings like we used to anymore. It's just a coincidence that this question, we have a gap opening here too. This is also from a Tuesday to a Thursday, so there must have been a holiday in here. Oh, it's the 4th of July. But I hold overnight, and I have my stops in immediately when the market opens, either on Sunday evening or a couple hours after the market closes during the week. Mm-hmm. And I'm not as concerned as I used to be, because I'm just waiting for the market to open. And once the market opens, I'm calculating my stops and putting my order in within 20 to 45 seconds.
Wow. Well, as usual, Brian, very impressive. Learned a lot. Every time you come in or I speak with you, I learn something new. Thank you for coming in and sharing some of your trading experience with us. I hope to have you here soon again.
Well, thanks, Brandon, for inviting me back, and I guess thank you to those tuning in today. All the best for future success.
Yeah, definitely. Also, everyone who attended today will be getting a free copy of Chapter 6 out of the Farnsfield's ebook, which is titled Analyzing a Track Record. There were a lot of people asking if there would be a recording. Yes, there will be. Also, everyone who attended today, like I said, will get that free ebook. You can find out more information on Brian at www.agfuturestrading.com. And if you have any questions that were not answered in the webinar, please email them to info@farnsfieldresearch.com. Hope everyone had a good day, and look forward to seeing you on the next one. Thanks again, Brian.
Thank you, Brandon. Bye-bye.